Hey guys, Nancy here. Hope everyone's doing well. Thanks for joining me. Look into some market movers. Now, this is going to be not to do with MTG. It's going to be mostly to do with stocks and also stagflation. I remember doing these videos back in 2021, and I was thinking it might not be a bad idea to get back into some of these more interesting economics discussions, especially now that we've kind of cooled down a bit from the craziness that was happening in 2021. And I still got hay fever, so bear with me. So, starting off, what do I want to cover first? What I wanted to cover first was what exactly is stagflation? Now, a lot of people are saying that we're not expecting stagflation, and that's probably true. What we are currently in right now would be considered stagflation, at least in certain places around the world. High inflation, low growth. The growth is lower than inflation, which means we have stagflation. How do you not have stagflation? When inflation falls behind or below growth. How are we going to do that? We're going to have to create another economic condition, which is either a recession or hopefully not a depression. Because a recession will mean enough people will be let go from their positions and jobs, not be able to make enough money to buy and bid up all of these different kinds of assets and products, and prices will fall, hopefully to a point where it's below growth over time. Otherwise, you're stuck in a forever loop where inflation and growth are never meeting at the right spot, and you'll always have stagflation. So, what is stagflation? It's pretty much what I just said, characterized, so Investopedia, characterized by slow economic growth and relatively high unemployment, or economic stagnation, which at the same time is accompanied by rising prices, inflation. So, how do we reverse that? Characterized by slow, so you need faster economic growth and low unemployment. So we don't have relatively high unemployment now. That's why we're not in a complete stagflation, but we certainly have slow economic growth compared to inflation, and we have very high inflation. So we would need higher economic growth, continue to have low unemployment, and we would need prices to stop rising faster than the economic growth. Currently, economic growth is averaging 2 to 3% a year. Inflation is averaging 8 to 9%. That is not good. And the longer it stays like that, the worse it's going to be for everyone. And truthfully, if it stays like that, in a high interest rate environment, you will want to own commodities, which are usually copper, silver, other materials, food. Yeah, you'd want to buy things that people need to survive and people are going to use to bet against inflation, if people think that's what's going to happen. And I have a feeling that there's at least some portion of the population that's kind of catching on to that. So inflation, the rate of increase of prices of something, so that's the acceleration of prices, not the speed. And economic growth, how fast GDP is growing around different countries. So this covers a lot. I think it's pretty cool. I'll just read the conclusion from Invesco. In short, our view is that stagflation is an extremely unlikely scenario in 2022, but that doesn't mean the Federal Reserve isn't concerned about inflation. In fact, moving closer to the full unemployment target means it can focus more on inflation. Navigating the current inflationary environment will not be easy for the Fed. It seems the most appropriate response for the Fed right now should be a relatively neutral policy, neither too loose nor too tight, because that can interfere with supply and shortages. And that's just where the Fed seems to be going now. Now, I agree that that's where they want the Federal Reserve to go. But judging by how fast the markets around the world are willing to loosen up based on their assumption of what the Federal Reserve is going to do in the future, I feel like the Federal Reserve is going to have to be a bit more aggressive than what people are thinking if they're actually serious about destroying or tackling inflation, bringing it back to the 2% average. So what do I mean by that? I meant in the last couple of months, every time we think the Federal Reserve is going to slow down, we get huge bear market or spikes in the S&P 500 and assets around the world. It applies to a lot of different countries. S&P 500 is the largest, and obviously stocks are not as important as bonds, but we'll talk about bonds another day. And these rallies in the stock market cause the economy to loosen by the idea of people having a wealth effect, which is businesses, companies, people that invest in, and most people nowadays, especially in most of the Western countries, invest in the markets, even if it's not a large amount. I think what 10% of the population has 80% of their assets in the stock market, but the other 90% still have assets in the stock market, and they have houses most of the time. And when they see the house prices and the stock prices going up, they don't sell the houses, but then they either borrow against it or assume that that price is now inbuilt into their pocket, so they can spend extra money that the house is appreciated in, with the understanding that they don't own that money, but they have got that money because they can sell the house at any point. If everyone decides to sell the house at any point, obviously house prices will drop. So that is imaginary or paper gains and not actually proper profits until you sell the asset. But the wealth effect is a real thing. If you have a lot of money in stocks because it's gained a lot, like not money that's savings, but it's actually gained, like let's say you put $100,000 in and it went up to $160,000, you might not take out the $160,000, but you might still go out and buy a new Tesla because you've made $60,000 in paper profit and you want to spend that money. So the reverse can happen as well. And I think that's what the Federal Reserve wants to do, is every time they see the spike going up, it loosens business and people's wallets to want to spend more money because they're making profits. And the Federal Reserve doesn't really want that right now. They want to tighten. So they need to bring the prices down in a way that makes sure that the economy is not loosening up, providing more liquidity to different, I guess, assets, and people bidding up prices of things just because they seem to have more cash. Also, a lot of people are borrowing a lot of money to get cars and houses, and interest rates are also going to do some damage as well. The next thing I want to do was talk about, and this is probably another day as well, which is quantitative tightening, which is how much money they are taking out of the economy that they put through in the last 12 years to save the world from the 2008 crisis. I think in 2020 they added about $4.6 trillion, and they have taken out around about 400 billion. So 1/10 of the money. Wait, is it even 1/10? Quick, get me a calculator. What is it? 9 trillion. I don't even know how many zeros that is. What is that? 1, 2, 3. So that's 9 followed by 12 zeros. Okay, sure. And divided that by 400 billion. What is that? Oh God, these numbers. That's 400 million. You guys can't see what I'm doing, but I'm trying. So they've done 1/20th. Yeah, okay. So 0.5% of the money they've injected in has now been withdrawn in the last 4 months, or something to that level. That is not much money at all that they've tried to take out. But it is important to know that every little bit they take out has a larger impact than a lot of people think. So it's pretty much it gets multiplied. The quantitative easing got multiplied when it entered in, and the quantitative tightening is going to multiply when it gets taken out. So we're going to see the impacts of that over the next couple of years if the Federal Reserve is serious. Another thing that's expected to happen is whenever the markets get close to or try to get above their moving day average of the 200-day, that's usually a lot of resistance. And we can see, at least for the S&P, that it is getting close to hitting that 200. So no doubt that it might try one more push to get to that 200, but when it gets there, it's going to hit a huge amount of resistance. And to break above it and then retest and then go up is the only thing that a lot of the market participants are going to be looking at. So I know that's a lot of information to cover, but S&P 500 getting near the top, we're going to have to see how that goes. DXY getting near the bottom, we're going to have to see how that goes. VIX, which is the volatility index, looks like it's getting near the bottom. Yeah, I guess that's about all I can say. It's getting near the bottom. It doesn't look good for the VIX, but at the same time, it can't possibly stay there forever because the markets are tightening, and most of the time, they don't like that. US 10-year yield, this is what gets you a pretty decent return, but also increases the house prices or mortgage rates. And currently, it is also bottoming out, but we'll have to see how that goes. Hasbro. Now, we covered this yesterday, but it actually had a 4%. I mean, I don't know if I said in yesterday's video that it was just super oversold, and I'd dip my toes if I could be bothered. But yeah, 5% gain is pretty decent, but at the same time, there's no fundamental reason why it's doing anything better other than the fact that the peer pressure might cause them to say something positive about what they plan to do. Australia and Canada, I am not sure what's going on here, but it looks like the Australian dollar is about to get destroyed again, unless it somehow breaks above this 200-day moving average, in which case it actually is stronger against Canada. But right now, it is not looking good at all. USD Canada, USD is doing pretty. Canada's doing pretty good. Like I said, I'm not too sure what's going on here, but maybe I don't know. Maybe the materials being taken out of Canada is actually good for the Canadian economy or something. That, like I said, they're doing pretty well. Probably not much more to cover today, but like I said, I just wanted to cover what stagflation was. What is probably going to be the impact in the next couple of weeks is we don't want to stay in a place where stagflation can happen. The Federal Reserve certainly doesn't want that. They would rather cause a severe recession rather than stagflation. I think the uneducated economist said something about they would rather get above 5% and cause a recession for the interest rates than stay below 5% and create stagflation or another recession later down the line, because then they don't have the ammo to bring it back down to zero to then stimulate the economy that they've just crashed. The boom bust cycle this time around is really messed up because of the low supply that was created by COVID in 2020 and 2021. Whether or not that was all well planned, I'm not too sure, but certainly the boom bust cycle is slower, later, and probably not going to be as severe because there just is not that much supply out there because of the last 2 years evaporated whatever supply, and the huge amount of injection of liquidity around the world inflated the prices. So yeah, a lot of people just don't want to sell. I mean, I certainly wouldn't want to sell my house for anything less than a very good price for what I would think it was worth, because I had to then buy another house in the same market, and yeah, you just can't unless you get a good price. So a lot of people are going to be thinking of that. Same thing with used cars, but I think houses might actually be better than used cars this time around because a lot of people leveraged up to buy used cars. In fact, this is not something I was thinking about doing, but let me just quickly show you guys something else that I might talk about in the next couple of weeks. Next couple of days. I really need to plan out the videos and make a cycle about what I'm going to talk about. But as you can see, over the last, since, August of 2022, car prices have actually come down. And some car prices, like a Tesla, have come down by 13.62%. A used Tesla is now going to cost you $57,000 when about 4 months ago, it would have cost you about $70,000. I think that works out. Maybe $66,000, $67,000. But yeah, so a used Tesla is now 13%. And you can look at some of these prices, like a Wagoneer, never seen or been in one, but 6% drop. There are some cars that have gone up. Pontiac, I don't know. Mercury, I've never heard of them. Jeep, went up by 3.6%. But even then, in the last 30 days, it has fallen. So if you look at this, this is an unbiased graph. it captured all of the gains of the last couple of years. And even now, it's not dropping anywhere near as fast as you'd expect. It's like slowly trickling down. It had higher spikes than it has the drop with all these interest rates rises, but maybe that might speed up, or depending on what's going to come out in the next couple of years. But used cars, a great way to look at what's happening around the world. This is probably one of the most illiquid liquid assets that's out there. They should not be jumping up at this rate, but people are trading them like stocks. And they are falling pretty aggressively because most of the time people take them out on loans. I've heard stories where someone borrows money, buys a new car. 6 months later, they get the car, then they sell it for a markup of $20,000, go up to the counter again and say, can I put an order in for another new car so I can then sell it again in 6 months? People are willing to buy these things on the spot. Just a couple of months ago, they may not be willing to buy these much anymore. And truthfully, if I was going to buy a used car, I'd wait another 7 months. 7 months, we'll see what happens. If used car prices don't drop by at least another 10% in 7 months, probably have no choice but to buy a new one, unless new ones go up. But at the same time, a used car costing almost as much as a new car, you might as well just get a new car, bite the bullet, wait 6 months to 1 year if needed, and get it that way. Anyways, guys, a bit of rambling, but thanks for watching. Have a good one, and see you next time.